All right, let's dive right in. Today, we are pulling back the curtain on a really powerful trading concept that honestly operates just beneath the surface of the charts. This is a strategy that isn't about cluttering your screen with a dozen indicators, but instead it focuses on the one thing that truly moves the market. Let's get into it. So let me ask you this. Have you ever been in this situation? You see a perfect setup, maybe on gold or Bitcoin. You place your trade, you set a nice, tight stop loss, and you're feeling pretty good about it. And then, out of nowhere, the price just darts down, taps you out, and then almost instantly, it reverses and skyrockets in the exact direction you predicted. It has to be one of the most maddening things in all of trading, right? Well, what if I told you that wasn't just bad luck? What if it wasn't random at all? What if it was a predictable, almost mechanical process happening right in front of you? You see, the market was just doing what it always does. It was moving toward its hidden engine, its fuel source, and that fuel source is liquidity. Understanding this is a complete game changer. It turns that frustration into a real tradable opportunity. So what even is liquidity? You hear the term thrown around a lot, but it's so much more important than the simple support and resistance lines that most traders are taught to watch. You can think of it as the market's true magnet, the force that's constantly pulling price across the chart. You know, at its core, liquidity is all about efficiency. It's the market's ability to handle a flood of buying and selling without going completely haywire. When a market has high liquidity, it just means there are tons of buyers and sellers at the ready, which lets you get in and out of your trades smoothly. Because at the end of the day, trading isn't really about lines on a chart. It's about one thing, matching orders. Now, here's where a lot of people get tripped up. Liquidity and volume, they are not the same thing. Volume just tells you how much activity is happening, how many trades are going through. But liquidity measures market depth, its ability to actually absorb those trades without the price flying all over the place. For instance, you can have super high volume during a big news announcement, but liquidity can actually be incredibly low, and that's what leads to those chaotic, erratic price spikes we all hate. Okay, so if the market is always on the hunt for liquidity, the million-dollar question is, where is it? Where does it collect? Where are these big pools of orders that act like magnets for price? Well, the good news is, it's not random. Liquidity clusters in very predictable places. Just think about it for a second. Where does nearly every retail trader put their stop loss? Right? It's just above a recent high, or just below a recent low. These areas, and especially the highs and lows of previous trading sessions, like the Asia session, become these massive, juicy pools of stop loss orders just sitting there, waiting. And here is the absolute key to all of this. Big institutions, we're talking banks, hedge funds, they need to fill gigantic orders. And to sell, say, $1 billion worth of an asset, they need a huge number of buyers. So where do they find them? They find them at the exact price levels where all those retail stop losses are clustered. That sudden price spike that stops you out isn't random noise. It's a liquidity hunt. They are literally using your stop loss order as their entry ticket. Okay, so now let's get practical. How do we turn this knowledge into a simple, rules-based strategy that we can actually use? This playbook focuses specifically on the handoff between trading sessions, which is where a lot of this action happens. And the process itself is beautifully simple. Step 1, we just mark the high and the low of the Asia trading session. Then, as the London or New York session kicks off, we do nothing. We just sit on our hands. We wait for the price to push above that high or dip below that low to go grab the liquidity we know is there. And only then do we start looking for our entry signal. This next part, this is the secret sauce. This is the most critical piece of the entire strategy. It's the confirmation signal that tells us if this is a real reversal setup or if it's just a breakout that we want absolutely no part of. And it all boils down to one simple golden rule. And here it is. This is the moment of truth. If the price pushes above the Asia session high, but the candle fails to close above it, leaving behind a big, telling wick, that's our signal. That's the market telling us the liquidity has been snatched up and the big players are done. This failure to close is our trigger for a high probability reversal. On the flip side, if the candle closes firmly beyond that level, that's a breakout, and according to this strategy, we don't touch it. No trade. Okay, theory is one thing, but let's see how this actually plays out on a real chart. We're going to walk through a perfect setup on gold, and then we'll look at a situation on Bitcoin where these exact rules would have saved us from a bad trade. So check this out, a textbook example on gold. First, the Asia session sets its range, and we just draw a box around it. Then, as the London session opens, the volatility kicks in. You can see the price shoots up aggressively, clearing out all those stop losses that were sitting right above the Asia high. But look what happens next. The candle leaves a huge wick, showing us that hunt for liquidity, and then it closes all the way back down below the level. It failed to close above it. That's our signal. That bearish reversal candle is our confirmation to go short.
Now, let's contrast that with this example on Bitcoin. The Asia low gets set. During the London session, price drops and takes out that low. But this time, look at that candle. It closes decisively below the level. There's no long wick at the bottom, no rejection, no reversal signal at all. This is a clear sign of strong bearish momentum. It's a breakout, not a liquidity sweep. So what do? According to our rules, absolutely nothing. And this discipline, the discipline to stay out, is just as crucial as knowing when to get in. Now, when we do get our signal and take a trade, risk management is everything. For a strategy like this to work over the long run, we have to demand a minimum reward to risk ratio of 3-to-1. It's that simple. It means that for every single dollar we risk, we are aiming to make at least 3. This is what ensures that even if you don't win every trade, the strategy stays profitable over time. And our stop loss? Its placement is simple and logical. It goes just beyond the peak of that wick that swept the liquidity. This gives the trade a little bit of room to breathe, but keeps our risk tightly defined. This is our safety net because, let's be real, no strategy is foolproof. Managing your risk is what keeps you in this game long term. Look, having a great rules-based strategy is awesome, but it's only half the battle. The other half, and honestly the harder half, is building the psychological discipline to sit there and wait for your perfect setup, and then to execute it without letting fear or greed get in the way. This quote just nails it. The whole point isn't to be trading all day, every day. The goal is to wait patiently for those A-plus setups that check every single one of your boxes. When you learn to skip the pretty good trades, you save your money and your mental energy for the truly high probability ones. Your biggest edge in the market isn't a fancy indicator, it's simplicity and patience. So, to wrap this all up, let's just hit the main points one more time. Remember, price is drawn to liquidity like a magnet. The highs and lows of trading sessions are huge liquidity pools. Your absolute key entry signal is a sweep of one of those levels without a candle closing beyond it. And finally, none of this matters without strict risk management and the non-negotiable patience to wait for your pitch. And that really brings us to the end of this deep dive. Now that you can see this hidden engine working behind the scenes, it kind of begs the question, right? Do you actively monitor session liquidity in your own trading? And how might this concept change the way you look at a price chart from now on? It's a really powerful shift in perspective, from chasing patterns to actually hunting liquidity.